be careful what you wish for. A $5,000 gold world is not going to be necessarily a happy place, even though your gold is up. The dollar is increasingly untrustworthy, unreliable, unsound. High definition inflation, it's monetary counterfeiting. Premiums totally collapse, which means retail in the West has decided to sit this one out. They don't trust it. They don't like it.
It's a historic year for precious metals. Never before in history have gold and silver climbed to the levels that we're seeing now today. So as history is unfolding, let's discuss what's next in this episode. What's going to happen now to precious metals? What can we learn from past cycles and extrapolate that to get a sense of what's going to happen to this cycle? Keith Weiner joins us today. He is the founder and CEO of Monetary Metals, and he's a very knowledgeable person, expert on precious metals. We'll talk about his view on what's next for not just the commodity space, but global economic growth. And also, he's got a very interesting company that has a very interesting, unique product that other bullion dealers don't have. We'll talk about that as well. Welcome back, or welcome to the show, Keith. It's your first time on the show. Not welcome back.
Thank you, David.
Welcome, your first time. First of many, I'm sure. But you've been on other media talking about gold and silver, and you've got a lot of interesting analysis for us today. Before we get into your outlook, so stay tuned for Keith's outlook, tell us about the biggest misconceptions that the general public has in regards to the gold and silver spaces that you've witnessed over the last couple of decades that you've been doing this.
Oh man, in no particular order, people try to analyze supply and demand of gold and silver the way they would with wheat, oil, or anything else. But the thing about gold, to a lesser degree silver, but also to a very strong degree, virtually all of the gold mined in 6,500 years of human history is still in somebody's hands. The amount of gold that comes out of a mine next year is a small fraction of the total. So if you want to understand, price action, you have to think of all of that gold that exists, that's been mined over 6,500 years, as potential supply under the right conditions and at the right price, and not just simply what comes out of the mines, 3,000 tons-ish. That's a big misconception. Another really popular one, I call it the famous buyer fallacy. The headline blares in the gold community: Bank of Ireland decides they're going to buy 7 tons. And the presumption is that, that Bank of Ireland knows something everyone doesn't, and the price of gold is going to go up. Well, what about if they're buying 7 tons, there's probably 50,000 or 100,000 sellers of gold that are selling the gold. Why do we assume they're all wrong and the Bank of Ireland is right? So I call it the famous buyer fallacy, because they're famous and, they can make headline news. Everyone assumes they're buying, but then all the sellers are neglected. Maybe the sellers are right, or maybe none of them are buying and selling for reasons of price expectations. Maybe there's something else going on anyway. Maybe the sellers needed liquidity, the buyer is shifting things around for whatever reason, geopolitics or otherwise. It isn't necessarily a price signal at all. But if you look at all these events of when famous buyers have bought, they don't necessarily have any particular correlation to a rising price. Sometimes yes, but sometimes no. Number 3 is the evergreen gold and silver price manipulation, suppression, conspiracy theory. And every time the price drops, it's deemed to be suppression and conspiracy. Every time the price rises, well, of course that's natural. Of course the price is supposed to go up. And no matter how much you write to debunk, and I think I probably have written more than anybody to debunk this, it's a hydra. You chop off one head, and 2 more sprout to take its place. So there's 3 for you, David. There's more, but
actually, just on that note, the second part. So central bank buying, is that really a big factor for driving up or down the price of gold?
Psychologically, it can be important, right? I mean, if the Central Bank of Ireland, I'm just remembering a headline from a few years ago, buy 7 tons. If that's a thing that motivates 1 million people around the world to buy, and then the price is going to go up, right? But is that because of the Central Bank of Ireland? Like the 7 tons they bought is nothing. But if 1 million people are motivated to buy, that could be a whole different story. So yes and no. And then there are underlying fundamentals why central banks and everyone else are buying today and why the price is going up. But I wouldn't attribute it to central bank buying as such. I'm not in that camp.
What have been the biggest drivers of this unprecedented rally in gold and silver? Let's focus on gold for now. Arguably, silver follows gold, so we'll talk about gold first. So above $4,000 was a landmark. Sustaining $4,000 was another landmark in itself, and now we're firmly above that territory to $4,200, and it doesn't seem to stop. They've used the word scared on my show to describe this price action. Does it scare you?
It is a little scary. I remember years and years ago when gold had a one handle and people were talking about $5,000 gold, and I used to say, well, first of all, number one, it's not imminent. And that being 15 years ago or whatever, it wasn't at that time imminent. Number two, be careful what you wish for. A $5,000 gold world is not going to be necessarily a happy place, even though your gold is up. So it is a little scary because it's the monetary system becoming unglued, and the gold price is simply the inverse of the price of the dollar as measured in gold. So as the dollar is going down, it's like the collapse of everything that everybody depends on. Our whole civilization is hung on this thing. That's not something that we should necessarily be cheering. But there's a reason why people are selling the dollar and buying gold, and that is the dollar is increasingly untrustworthy, unreliable, unsound. My definition of inflation has nothing to do with the quantity and nothing to do with the general price level. My definition of inflation is monetary counterfeiting. It's a fraud, and we have a lot of inflation going on, a lot of abuse of the dollar and all the other currencies. The dollar is not unique in any regard, and that abuse, more people turning to gold as the escape hatch. You don't want to hold, you don't want to be all in on this asset that the issuers of it are cheating. And I think the cheating becomes more and more blatant, and therefore more and more people perceive it to be obvious. That said, a lot of this rally, certainly retail investors in the West, have been setting out for the last 18 months. They were participants at the beginning of this. The more the price went up, the more that they lost appetite for it. And I think that's an example of Pavlov's dogs. There were so many blips. If you look at the last peak in the gold price, which was August of 2011, after that, every time the price blipped, it was not durable. The price was headed down after that. And there was, I don't know how many of those episodes, Pavlov's dogs were trained. And now the price has gone up and people just aren't. Western, retail investors just haven't, been trusting it. And yet, it's real. Now, who have been buyers are, one, Western institutional investors are building their gold positions, and particularly this year, and not as much in 2024, and I don't really think in 2023. And the big mass buyers are, I'll say here, I'm in Dubai at the moment, in the Middle East and the East. And you have the convergence here of four worlds where they're buying gold hand over fist. You have the Chinese world, the Indian world, the Turkish world, and the Arab world. And three of them are buying gold out of fear of their own government and their own currencies, and nothing to do with the dollar, which they prefer over their own, which is China. It's illegal to dump the yuan and buy dollars. And yet a lot of them are risking their lives to do so. But they can buy gold to some degree, so they buy gold. In India, the Indian currency is designed to go down, and over long periods of time, it goes down about 8% a year against the dollar, which, as we say, has been going down. So the Indian rupee is a terrible currency. The Indians don't really think of it as savings. It's a transactional currency. You get paid your paycheck in rupees, you spend it, and the rest you put it into gold. And that's always been historically the case in India. In Turkey, you have a case of a currency that is potentially facing a hyperinflation, and it's come close a number of times and so far flirted with it, but then backed off. But that's definitely not a currency that anybody in their right mind would want to hold. And then finally you come to the Arab currencies, which are stable and they're pegged to the dollar, and those pegs have been table flat for decades. If you're an Arab, you don't necessarily have to worry when you wake up tomorrow morning, your currency is going to be down 30%, like some sort of Banana Republic peso. Yet, they would prefer dollars to local currency for holding large amounts of wealth, because it's one-way risk. It's certainly not going to be the case that, the rial or the dinar or dirham are going to go up against the dollar. It's only one-way risk. But they love Americans. I mean, I feel really welcome here, and I think it's great. They don't love, let's just say certain government policies that we have right now, and they don't love the monetary policy. So they are looking for an escape hatch. So that, of the four worlds that are buying gold, that's the one that I think is the most clear anti-dollar play versus anti-yuan play, anti-lira play, anti-rupee play.
Yeah. And I just want, so I brought up, I framed this discussion as misconceptions about gold because it's important to understand what the actual narratives are versus fake narratives. So you've addressed some of these. So I want to touch on the dollar narrative and also the inflation narrative in a little bit more detail now, starting with the dollar one. Here in the West, we often hear, especially from gold analysts, that the dollar needs to fall dramatically for the gold price to rise, or if the gold price rises dramatically, that signals an imminent collapse of the dollar. Well, you brought up a good point, which is that a lot of the buying comes from other countries. Why would they care about the dollar? They would care about hedging against their own currency. So it's not just hedging against the dollar, it's hedging against any fiat depreciation, correct? Or is the gold market specifically an anti-US dollar asset versus just an anti-fiat asset overall?
Yeah, so the case I just made is that in Turkey, India, and China, they're buying gold more about being an their own currency asset versus anti-dollar. Now, the rest of the world has a complex relationship with the dollar, and because there's multiple different transactions and different kinds of parties. On the one hand, every major balance sheet is financed in dollars. There's something called gel-man amnesia, which is the syndrome of people who read an article on page 1 of the newspaper, which is total rubbish, and then they turn to page 2 and they return to total credulity, as if the paper hadn't blown its credibility on page 1. So if you Google that, there's a Wikipedia article or something that quotes Michael Crichton as saying that there are lots of newspaper articles that say wet street causes rain. And right after that, you're on to the next article that people believe. So you'll read one article about de-dollarization, the next will be about some major UAE project here where they just issued a bond for several $1 billion. The world is financing itself in dollars, has been, and it will continue to do so. All of the debtors around the world for these major capital projects owe dollars. The major corporations owe dollars. The major banks owe dollars. Which means if the dollar goes up, the liability is going up. Imagine you have a mortgage on your house and the mortgage is going up. And there's only so much of that you can take before you're bankrupt. So that is very concerning to them. As you can imagine, the debtors who owe dollars would rather have the dollar go down. But on the other side is the mass investor public in these countries where they hold dollars as an asset, not as a liability. And when it goes down, they're very concerned. And when it goes up, they're cheering because they see themselves making gains in the same way that Americans or Canadians, when we own gold, when the gold price goes up, we see it as capital gains. Everybody loves capital gains. So it's kind of a complicated thing. If the dollar goes down, there's a group of people around the world who hate it. If the dollar's going up, there's a different group of people around the world who hate it. And those tend to be more powerful and influential.
What is gold's relationship with consumer strength, consumer sentiment, and the overall health of the labor market and the economy? So I'll bring this up for you. There have been conflicting signs as to what, I'm talking about data now, economic data, as to what the economy is actually doing. Some signs point to growth, some signs point to a slowdown, especially in the labor market. The Fed themselves have admitted that the labor market is slowing down. This is an interesting piece of information that was just brought to my attention by my team. New Black Friday data shows just how stretched the U.S. consumer really is. 95% of all Black Friday sales volume was financed. Nearly 70% of those buyers don't plan to pay it off within 30 days. BNPL, buy now, pay later usage alone topped $1 billion, making this the most debt-fueled holiday shopping spree on record. The wild part, shoppers are financing discounted items right as interest rates remain as at multi-decade highs. I don't know if this is an indicator of consumer strength. Perhaps people are just taking advantage of loans, really cheap loans, and this is a relatively new trend. But certainly we've seen more stories along these lines indicating layoffs happening at the same time as people afraid to lose their jobs. So if you get laid off now, people are talking about the permanent layoff. You're not going to find a job anytime soon. At the same time, people are buying stuff on credit that they may or may not even be able to afford. All at the same time, gold is going up. Coincidence? I don't know.
Gold, as I was alluding earlier, is the thing you turn to if you don't trust the banking system, you don't trust the credit system. So the more that the credit system is loaded up with, or maybe overloaded with, rubbish credit that isn't going to be repaid, whether it's a government, governments, they call it borrowing, but they're just pissing it down the welfare drain. It's never going to be repaid. And the same thing if someone loads up on debt in order to buy electronics or other stuff that's going to, clothing, that's going to be worthless in a year, but the debt is going to linger for years or decades. People, investors, savers, they're not stupid. They can see this and say, this is unsound, right? The dollar's getting worse.
Yeah.
And people turn to gold as the antidote rather than loading up on that paper, whether that's the credit card issuers, sell bonds. There's all kinds of things that people may not prefer. They'd rather have the gold at some point.
Central bank monetary policy, how important is that? And we're looking at the Fed lowering rates, which may bring down the short end of the curve. And at the same time, Japan is raising rates. So capital flows away from the U.S. into Japanese assets. I wonder if that's contributed to overall market performance and ultimately gold market performance.
We one of our gold market outlook reports years ago, we looked at is there a correlation between the gold price and interest rates? So we looked at really short-term interest rates like the Fed funds rate. We looked at long-term rates like the 10-year bond or maybe 30-year bond. I don't remember what we did. We looked at so-called real interest rates. By the way, I just have to go on a little rant whenever that topic of nominal versus real comes up. So the rate at which actual lenders actually lend actual dollars to actual borrowers, we dismiss that as mere nominal. Then we make this adjustment based on inflation, which even the proponents of this can't really agree as to what goods have to go in the basket and how we measure inflation and with what weights and so on, and how to hedonically adjust, because cars today are better than they were 30 years ago. They're also more expensive. How much of the higher price is you're buying more car? How much of the higher price is inflation? So we come up with all this magic numerology to come up with an inflation number. Then we take the actual rate at which actual dollars are lent, subtract this hokey thing that nobody agrees on, and the net result of that we call the real interest rate. And no transactions actually occur at the real interest rate. All the transactions are at the nominal. Anyways, rant aside, we did some charts showing the gold price against short-term rates, long-term rates, real rates, and over long periods of time, there's not a particularly good correlation. So what I would say is that central bank policy does impact gold, because the higher the interest rate, the more the opportunity cost there is to hold gold. If you hold gold conventionally outside of monetary metals and what we do, you don't get any yield on it. If you hold a treasury bond and they happen to be paying 5.5% at that moment, there's a high 5.5% return. And so in a certain sense, you can say the opportunity cost of holding gold is 5.5. If the interest rate is pushed down to zero, then the opportunity cost to hold the gold is zero, and gold is relatively more attractive versus T-bills or other things that have a zero yield. So yes, in that sense, but it's complicated because there's a number of nonlinear positive feedback loops in the economy that can dominate these simple little heuristics like that.
Let's focus on inflation now. You brought up inflation, and you define inflation as not just the rise in the CPI, but the rise in the monetary base, I believe is what you said. I'm paraphrasing here. But
no, I define it as counterfeiting. Actually, it's
counterfeiting. What do you mean by counterfeiting? What exactly is being counterfeited?
So legitimate credit, the borrower has the means and the intent to repay. If your 14-year-old kid comes along and says, "Dad, can you spot me $1,000?" And you're like, "Well, what do you want to use $1,000 for?" And he says, "Well, me and my buddies want to go party." And you're like, "Well, how are you going to repay the $1,000?" He just shrugs and he just smiles and he says, "Well, just lend me the money." You may give him the money, you may not, but if you give him the money, you know that you're never going to see it again. Now imagine if 100,000 dads across the country pooled all of that paper into some 14-year-old backed security, a 4BS they'll call it, and they get a credit rating on it of AA, and they sell that in the capital markets. And now investors are buying this paper and they consider it to be real and they expect to get a coupon and everything else. But it's backed by 14-year-olds that are just like, "Yeah, Dad, just give me the money. I want to go party with it." There's no intent or means to repay it. It's a counterfeit. That is not going to be repaid. It can't be because the debtor, the obligor, doesn't have the means or intent. So when the government, they call it borrowing, but they piss it down the welfare drain, it's not going to be repaid. It cannot be repaid. And so I'm calling that a fraud or a counterfeit. And so that is what I define as inflation, whereas the actual quantity of the stuff itself doesn't really matter. As long as the credit is sound, then everything's fine. But if you start to replace sound credit with unsound credit, that's when all the problems and all the fun begins.
What do we have now, in your opinion? Unsound or sound credit?
An increasing proportion of unsound, a decreasing proportion of sound credit.
What do you think of the people?
That's a long-term trend.
Well, okay, we'll come back to that. But what do you think of the analysts who are online talking about how hyperinflation is about to come? And we're talking about really high, if not just outright hyperinflation of consumer prices, not just expansion of credit. We're talking about the CPI reaching double digits. Now, I can smell the comments from a mile away. Well, David actually believes in these actual CPI numbers. Well, I'm just using what the market is using, which is government numbers. So right now it's about 3%, nowhere near hyperinflation levels. Yet gold has reached all-time highs and above. So clearly, gold doesn't need inflation to skyrocket out of control for it to reach, astronomical levels. It's been proven time and time and again that gold doesn't need inflation to go really high to go up, and gold doesn't need inflation to plummet to go down. What do you think of this?
No, that's right. We did graphs of gold versus CPI inflation and found the same thing. They're not particularly well correlated. Now, there's several reasons for that. One of which is that there are a number of very large non-monetary forces that push consumer prices in both directions. The obvious one pushing it down is production efficiency is always increasing. Companies are always figuring out how to produce more with less. So I wrote an article for Forbes back in, 2012 or 2013, and I got some great data from the Wisconsin Dairy Association between 1965 and 2012. And I was looking at how much real resources go into producing a gallon of milk that you buy in the store. And it was about a 90% reduction in land, a 90% reduction in labor, about a 90% reduction. So if that was the only force affecting the price of milk, you'd see a 90% drop, in the price of milk in the store shelves, which of course is not what happened. So there's other forces pushing prices up. And broadly, I characterize them as useless ingredients. So the government is always forcing producers to put more and more stuff, whether it's literal ingredients, like when you buy gasoline. I don't know how it is in Canada, but in the US, there's a mandatory MBTE, methyl buta tetraethylene, I think, that has to be going to the gasoline, and that adds, 25 or 30 cents a gallon. It's useless. It doesn't do anything. It doesn't make your car more powerful. It makes your fuel economy slightly worse. But it's mandatory. That is happening. Every product, every category, every market across the board is relentlessly pushing consumer prices up massively over the decades. Not monetary, and gold's not going to react to that.
It's digressing. It does seem interesting. You brought up gas at the pump. The real inflation-adjusted price of spot oil so the WTI or Brent, is actually down on a 10-year adjusted basis. And yet gas prices are up at the pump. One wonders why.
So it's a wider spread between the commodity and the consumer good.
Yeah.
And that's because most of the compliance and most of the regulations hit the consumer good more than they hit the production of the raw commodity. So anyways, you have non-monetary forces, you have monetary forces. The gold is going to respond to the monetary forces, of course, but not the non-monetary forces.
I'm going to get to a few charts that you share with us and then ultimately get your outlook for gold and silver. But let's close on the macro discussion with this final question. Could you make the statement, Keith, that the price of gold is inversely proportional to our rise in living standards?
Price of gold is inversely proportional.
In other words, when price of gold goes up, it means our living standards are going down, and vice versa.
Not necessarily. I wouldn't necessarily say that.
Okay, I have here a few charts that show the gold technicals here. So here we have well, why don't you explain what we're looking at? Gold basis continuous.
So first of all, the green line is price, but it's the price of the dollar measured in gold, which is the inverse of how most people think of it and quote it every day. So when people talk about the dollar going up or down, usually they either mean measured in consumer prices or they mean measured in euros, which is basically the dollar index. But we measure it in gold for a variety of reasons. And so what we can see is during the period of this graph, which is, roughly July through present, you notice the price of the dollar going down from roughly 9.5 milligrams of gold to 7.5 milligrams of gold. It's a pretty big drop, which means the price of gold, rising during that period, which shouldn't be a surprise. And then the rise ended in kind of mid to late October, and then, it has been resuming from, second week of November. The red and the blue, the blue is the basis, the red is the co-basis. Those are our metrics for the abundance and scarcity, respectively, of gold. And, they're quoted as sort of annualized rates. That's not necessarily that important. The most important thing is to see the trend. And so if you see, in the case of gold, from, early September, these things are basically flat lines. There's a little bit of motion, plus or minus 4% in the blue line and negative 4% in the red line. But they've been pretty flat. Now, what's notable and what's very different, I referenced earlier, post-2011, every time the price would blip, it wasn't durable, it would come back down. What we saw then, time and time and time again, as the price would rise, so would the basis or a measure of abundance. Now what we see is a massive rise in price, and yet the blue line is basically a flat line across the entire graph, meaning gold's not becoming more abundant, less abundant or scarcer as the price is going up. It's remaining flat. That indicates you have a much more durable trend of rising price, which is what we've seen.
Okay, and importantly, the gold-silver ratio has fallen and massively. And we're this people have been talking about what the fair gold-silver ratio is. Do you have that number, by the way? And then we'll talk about this chart.
I'm not sure if there's one magic right number. What I will say, I tweeted yesterday, this came up, it's not 15 to 1. Right? Anybody buying silver.
Some people were saying that miners, the historical gold to silver ratio from a mining perspective and the output perspective is 8 to 1, 15 to 1, right? So that's the natural gold silver ratio of the planet, but
not going to happen financially. The conditions that existed in 1800 when you had a gold silver ratio of 15.5 to 1 do not exist anymore. And it's a long abstract argument, but clearly the gold silver ratio could fall a lot, and it did. We had 90 and all the way up to upwards of 100 and something, on and off for years, and all of a sudden you see this ratio falling, which means the price of silver is up considerably more than the price of gold in percentage terms.
Is this a normal cyclical issue where we have silver outperforming gold in the bull market, or is this specific to just this year because something's different?
It tends to happen in big durable bull markets. In fact, it's one of the signals a lot of people look for. Now, I don't put as much stock in that as a lot of other people might, but if this is a big and durable bull market in the metals, yeah, you should expect, at least for a time, especially if you're coming off a gold-silver ratio above any historical norm at 90, you should see a period of silver outperformance. And we're seeing that drop from over 90 to 70 and beyond. So yeah, I think that's normal, and that's showing that this cycle is not different from previous cycles.
Well, what do you think of silver overall? So here I have a gold. Let me just show this chart. Gold to silver basis ratio. What does this tell us?
So this is the ratio of the gold basis to the silver basis, and which is the blue line, and then the gold co-basis, silver co-basis. So when the blue line's above the red line, that signals silver is likely to outperform. And this particular time, it's not always this perfect. It's not. This looks like a real ringer, but this particular time, man, does that line up with this period of what a drop in the gold-silver ratio, which means silver outperformance. So the indicator nails it perfectly at this time. It's not necessarily always that neat, but here it is. And at least at the moment, you can see we're coming to an end where the blue line, as of yesterday, the blue line and the red line are literally touching at the neutral point, indicating that move may be over. Now the blue line can take off again. You can see there's some volatility in this chart, but we did have a heck of a run. Now, personally, my macro view, leaving aside, this is kind of telling you current market conditions. My macro view is that the metals are in a durable bull market, i.e. the dollar is in a durable bear market for lots of reasons, including the increasing counterfeiting of credit, the abuse of the central banks, and other reasons. I think this has got legs. I do not expect, this is it, the top is in 4,200, and then we're back to 2,000 again, or whatever. No, I don't think that's likely to be the case.
Well, Keith, what do you think is going to outperform going into 2026, silver or gold?
Now, that chart is saying, at least in the next go-round, probably gold. Longer term, I think a bet on silver could be a good bet.
The fact that silver has reached above $50 and sustained that level, and it wasn't some product of manipulation or bank squeezing or Hunt Brothers or whatever narrative you want to assign, this is just the market placing it above $50. What does that signal to you?
I think it's a little premature to say, but my guess would be 50 had been the ceiling for the longest time, becomes the new floor. Now, you reference Hunt Brothers. In October, the silver lease rate, another measure of silver's scarcity, spiked to 20% in the London market. So silver became real scarce for a brief moment, and I think the conventional explanation of it is that in India, gold has become unobtainium in a way. It's too expensive. So people are substituting and they're getting silver jewelry versus gold jewelry to some degree. But what is true is that physical metal became scarce, which is why the lease rate, spiked up. And you had a similar kind of episode when the Hunt Brothers tried to corner silver, when Warren Buffett tried to corner silver. Anytime there's a major amount of physical buying, you get the scarcity, and what happens is the price goes up. And the price going up does two things. Whoever is buying it buys less, and whoever might want to sell is more inclined to sell because they get a higher price. So that did happen. The backwardation that occurred in silver in October was bigger than anything I've seen since I've been watching it for going on 20 years. And the biggest thing we have in our data set.
The fact that silver is now firmly above $58.50, how have the physical markets responded to that price? So you're a bullion dealer. You're perfect to ask this question too. What are you seeing in terms of premiums? What are you seeing in terms of retail buying activity and what they're interested in? Are they more interested in silver coins? Are they more interested in gold coins and bars? Where is retail capital headed?
So we're not really a bullion dealer. I mean, we're here to pay interest on gold and silver in gold and silver.
Okay.
But we do have some visibility and some insight into it. Premiums have collapsed. The premium on a silver eagle nowadays is cents. I mean, it's 1%. And it wasn't too long ago that people were paying 30-50% premiums on silver eagles. So the premiums totally collapsed, which means retail in the West has decided to set this one out. They don't trust it. They don't like it. That is definitely true. Now, not the same story for retail in the East, and not the same story for institutional, but retail is not having any of this.
Can we offer an explanation as to why? That seems counterintuitive.
Well, price has gone up. They've been burned before and buying, on a rising price. They don't trust it. I mean, that's the psychology of it. Now, that can flip. If it stays up long enough, at some point, 50 is perceived as the relative bargain, and then you pull back to 51 or 52, and you get a lot of buying.
So tell us about your company now, Monetary Metals. First of all, why is it called Monetary Metals? Let me just address the name here. So we're talking about gold and silver primarily. They were monetary metals at some point. People no longer transact with gold and silver. So why do we still consider them monetary metals?
So it shouldn't be surprising at this point. My definition of what makes money is a bit different from the mainstream. I don't define money as what is used in transactions necessarily. To me, money is the most marketable commodity, and gold still is. Gold has by far the highest stocks to flows, the tightest spreads. The spreads widen the least as you do big volume transactions. And gold is accumulated without any apparent limit. The concept of glut does not apply in the gold market, that it would in the wheat market, copper market, oil market, you name it. So it still behaves as money economically, even though no one's using it, or very few people are using it for transactions here in the West. Now, I have a funny anecdote to share. So I visited a jewelry wholesaler, here in Dubai a couple of weeks ago. And if you want, I can send you the picture. I took a picture of myself holding, they have this gigantic bolt cutter. I mean, this thing's like a meter long. I mean, it must weigh, 20 kilos. I don't know, it's pretty heavy. And I kind of joked, I held it up. I took a picture, they had a picture of me that we took. And I was like, what the heck do you need this for? You must be cutting into some seriously high security, padlocks. They said, no. We use that to cut kilo bars. I was like, what? Oh yeah, so our customers pay in kilo bars, and when we have to make change, we cut the bar. I said, whoa, because I've been writing for years that one of the problems with bigger bars is the lack of fungibility. If I have a kilo and we need to do a smaller transaction than a kilo, how do you deal with that? And I've always joked, like, well, gold is soft. I mean, you can cut it with your knife, but no one is going to cut a bar. Well, yeah, they do. They chop it with this giant bolt cutter. That's how they make change. And I was just like, well, you just made me wrong. I've been writing about this for years this way. So that's normal in the jewelry market here in Dubai, in India, I'm going to presume in Turkey, although I don't have any direct evidence in Turkey, but in India, yes. And the rest of the world is doing all kinds of things that make solutions that we in the West would just be like, huh, really? So yeah, gold is used in transactions in certain places more than we might think. But gold still behaves as money. Silver still behaves as money. It's the thing that people want to accumulate without any particular limit, which is what you get for money, but not an ordinary commodity. So anyway, what we do at Monetary Metals, we pay interest on it. If gold is money, if that's the thesis, you should be able to do something with your money to get a return. And we do that with gold and silver.
It says on your website, you estimate $150 billion a year is spent on owners paying to store their gold. So that is a problem. If you buy physical, you have to pay storage costs. That's why some people buy ETFs, but you still have to pay a management fee on your ETF. So how did you go about solving this problem?
So we started out with the idea that, hey, if we offer interest, people will bring and deposit their gold. How do we do it? Well, we have a leasing program where there's a lot of different industries where they need physical metal in the business. For instance, jewelry store. Average jewelry store here in Dubai is about 50 kilograms of gold physically on the shelves and in the display cases. That is refinanced. Somehow, the best finance for them is a lease. It's off balance sheet. They have no price exposure, and they pay interest for the privilege of getting the finance. So we make a little spread on it. That's how we make our money, and the investors get paid interest on their metal.
People have been wary of businesses paying interest on assets. Started with cryptos. Same thing with hard assets. We've seen how certain crypto companies have operated like basically a Ponzi scheme, investor money coming in to pay interest on other deposits, right? Now, people are going to ask you the same question. Well, this sounds like a scam. This sounds like a Ponzi. We've seen this before. How is it not, Keith?
The difference is, in all these crypto things, it's all circular and self-referential. They want to generate the return intrinsic to a closed-loop market. It doesn't work that way. We've gone out to real businesses, and some of these are public companies like Kalyan, who we've announced. So anybody who's Indian, who's been in that part of the world, recognizes Kalyan as a billion-dollar plus public company.
Yeah, here it is. So you've got Kalyan Jewelers Limited, India Limited, publicly listed jewelry retailer, Goldie's right. Annualized rate 3%. How does this work? Just tell us about this deal.
So Kalyan has hundreds of stores, each one of which would have about 50 kgs of inventory in it. So we come and finance that inventory. That is, we own the inventory in the store on behalf of the investors. And they pay interest for the financing privilege. So it's not circular or self-referential. It's not self-contained within a digital platform. This is doing a real deal in the real world with a real company who has a real finance need. These companies have tons and tons, literally tons of gold in their stores that has to be financed. So that's what we do.
Are interest rates determined by the market, or do you set private deals, or how does it work?
Yeah, so that's the interesting thing. It's the first time that an interest rate is set by free actors in a free market in over a century. Everything in the dollar world is a spread to treasury bonds or treasury bills. And so whatever the Fed is doing, it's affecting all manner of private credit. But in the case of gold, you have the right not to participate, and you participate only if you think you're getting a good deal. And so the investors set the floor on the interest rate. If the interest rate were too low, the investors would not participate. If the interest rate's too high, the jewelers won't participate. And so you got to find the place where the most amount of gold clears, and that's how the interest rate is set.
Walk me through how this works. I'm a client. I deposit some gold to Monetary Metals. Is that correct so far? And then I earn a yield.
You can either give us physical gold, or you can send us a wire, and we'll buy the gold and put it in your account. Then
where is the gold physically if I send you a wire?
So we'll buy it and stick it in. We have a network of vaults and depositories that we use. That's okay. Temporary only until the next lease. Then we present you, okay, here's the next Kalyan tranche. And you say, okay, yeah, I want my gold to go into that. And then after that deal closes, your gold is now in the Kalyan store rather than in the vault.
Can I redeem it anytime I want?
It's a 1-year contract.
Okay, so it's locked up for 1 year, and after that I can redeem the gold, and then right. During that year I can earn an interest on the savings. So how is that interest rate determined?
As I said, it's a market. So if it's too low, you're not going to do it. If it's too high, Kalyan's not going to do it. Mm-hmm. So there's a happy medium that both parties are willing to do, and that's where the interest rate is. So going forward, the interest rate's basically 4%. That Tombstone, it's called on our website. That deal was struck a year ago when the rate was 3%. That's currently
Does accredited investors earn more yield? Is that correct?
We have other deals where we're doing lending. Let's say to mining companies, much higher interest rates, totally different, and obviously higher risk. That's for accredited investors only. The leasing is open to everybody.
If someone wants to say, well, is there an audit to know that the physical gold is actually there? How would you answer that?
We are audited. We have, a number of things. I'd say call us and we can talk you through what are the risks and what are the mitigants.
Anything else that makes monetary metals unique in this particular space?
We pay interest. I mean, that is the unique proposition.
In theory, anybody could do this, right?
I mean, any business, in theory, somebody can get into it, but it's hard. It's hard because people don't get it. It's hard because there's a lot of stuff you got to build. You got to figure out regulatory compliance. You got to figure out how to mitigate all the risks. You have to build flows. Now, I suppose there's one other thing that's worth saying. We're on a mission. There's a what. Okay, we pay interest in gold, right? It's simple enough. There's a why. And the why is, and you get back to the name monetary, we would like to bring back the use of gold and silver in a more monetary way, and that is to allow savers to earn and accumulate by compounding interest and to use the metals productively. We understand why people bet on the price of the metal. You buy it, it goes up, you sell it, we made a profit. But we'd like to make an alternative available where you don't have to sell your metal to profit from it. So today, if you buy the metal and it goes up, there is no way to profit from it unless you sell it. So you bought the metal because you said, I think the dollar's crap. Okay, then the price of gold goes up, so you're proven right in a sense. But then you sell it to get more of the very dollars you just said were crap. It doesn't make sense, but without interest, there's nothing else to do. Nothing else you can do. So we're on a mission to make gold a more serious alternative and give people a choice that, conventionally doesn't exist.
All right. Excellent. Thank you very much. Where can we follow you, Keith?
My Twitter is @RealKeithWeiner, and the company website is monetary-metals.com.
Okay, we'll put the links down below. So follow Keith and Monetary Metals down there below. And thank you very much, Keith. We'll speak next time. Thank you for coming on and supporting the channel. Appreciate it.
Thanks, David.
Thank you for watching. Don't forget to like and subscribe.